This is Terrence Andre Banks coming today from Information Age Financial Solutions. Reading an article from Charles Hugh Smith. I haven't looked at his stuff in a while, but he wrote two very good articles, and I wanted just to give the links to them. One I found on dollarcollapse.com. This one's done in April 30th. Just read over because not the 70s or the 20s. We're in uncharted territory. The title alone caught my attention, as always with my videos. So I wanted to kind of dive in and encourage people to take a look at it because he does some really good information pointing. And when a person has this much experience and does that much research, it's worth you paying your time to. So I'm going to kind of dive into this article, and then I'm going to read another article that he has as well. The waking of inflation after decades of slumber has triggered a flurry of comparisons to the 70s. The similarities and differences are setting up a sea change revaluation of capital resources and labor on the same scale as the transitions of the 1920s and 1970s. The awakening, accompanied by a chorus of objectives for the 1970s type stagflation, defined as inflation plus economic stagnation, limited or negative growth, and high unemployment. A less popular comparison is with the 1920s, a massive expansion of debt, an equally massive speculative bubble in assets, and extremely wealth and income inequality, all against a backdrop of slowing growth and debt saturation. Each of these areas share certain characteristics with the present, but beneath the surface they are consequential systemic differences. Let's start with the 1970s. The oil shock that fueled inflation had two sources. One, the oil exporting nations took control of the hydrocarbon resources and repriced them in the context of two, declining reserves and production in the West, particularly in the United States, which has been the Saudi Arabia of the world through the 1930s, 40s, and 50s. A second, much less understood dynamic was the immense investment required to clean up the U.S. industrial base. Pollution in the U.S. was out of control by the early 1970s, with toxic rivers catching fire and high levels of air pollution. The oil shock prompted federal regulations of pollution improvements in the basic efficiency of appliances, vehicles, etc. This was a major sea change for the entire industrial sector, and it required immense investments of capital and painful learning curve. The diversion of capital depressed profits and acted as an economy-wide tax on the system. In today's money, the overall cost of this transition was in the trillions of dollars. The debt levels in the 1970s were, by today's standards, absurdly modest. The culture vagues of frugality and avoidance of debt still held, and there was resistance to heavily public-private borrowing that has completely vanished. So people weren't borrowing that much money, and the debt balance was extremely modest. The demographics in 1970 were also completely different from today, which is good. The 65 million strong baby boom generation was entering the workforce and starting families and enterprises. The demographic double whammy was the mass entry of women into the workforce as opportunities and ambitions expanded. Meanwhile, the energy picture was brightening under the radar. As the development of newly discovered supergiant oil fields in Alaska, the North Sea, and Africa began, it took many years to bring these new hydrocarbon sources online. But by the mid-1980s, the price of oil had fallen to lows that slashed the income of oil exporting nations, including the Soviet Union. None of these conditions are present today. Much of America's domestic production was offshored in the past 20 years. The demographics are no longer as favorable, soaring population, elderly, and flatline workforce, and the production from the supergiant fields brought online in the 1970s is declining. There are no supergiant fields in the global pipeline to replace those in the depletion phase of declining production. As for the 1920s, the parallels of debt saturation and speculative excess against the backdrop of an economy that feasted on debt-fueled spending and speculation while absorbing new technologies. The difference are the U.S. still has an immense natural resources and relatively limited infrastructure in 1920. While private debt was through the roof, $100 in stock market account leverage 900 in stock purchases, due to the 10% cash market requirement, federal debt was still modest compared to modern levels. This sets the stage for mass expansion of federal debt in World War II that funded sustained investments in infrastructure through the 1940s and 1960s. In the present, we all have the fragilities of the 1920s and few of the strengths. We have all the debt saturation and speculative bubble excesses, but our resources have been heavily tapped, and every sector of the economy is heavily indebted. All these similarities and differences are setting up a sea change evaluation of capital, resources, and labor that will be on the same scale as tumultuous transformations in the 1920s and 1970s. We are in uncharted territory. Most of these evaluations, more of these evaluations next week. I kind of read through the article quickly, but try to cover all the points. High level thought process and just understanding resources, and he even broke down different time frames to even compare it to. Definitely an article worth your attention and paying time to. I found it on Dollar Collapse, but you go to his site, up2minds.com by Charles Smith. I'll read another recent article he did. Heard on the street was another one. This is phenomenal. The casino has become complex, and there are no easy answers or predictable paths. The Wall Street herd had its easy. Oh, I'm sorry, I lost my train of thought. Life was simple. Heard it easy from 2009 to 2021. Life was simple and life was good. Markets were easy to predict as long as the Federal Reserve kept interest rates near zero and increased its balance sheet to buy Treasury bonds. The stock market rose. As long as the Fed increased its balance sheet to buy mortgage-backed securities, housing rose. If the Fed tried to reduce its balance sheet, the market would quiver and shake through a tantrum, and the Fed would go back, keeping interest rates near zero and increase its balance sheet. To make money, all one had to do was buy the dips. Easy peasy. And that's where you have all of these YouTubers came out, and all TikTok, and everybody talking about stock trading, options, and all kinds of insanity, especially for people who just haven't had enough experience. And also have not done enough study. And now they're taking financial aspects as the new religion. That this is just the easiest world is, and you too can be not work and just live the life of as an investor and a day trader. I say all that because it's just comical to continue to see. At last, life is not so simple these days, and the herd know quite which way to run. Dynamics that were regulated to the margins for about 13 years have emerged from the shadows to complicate the process of making money in markets. Inflation has risen from the depths, breathing fires, stampeding the herd. The herd herds. Here's all sorts of measures, and it can discern signal from noise. Inflation and transitory. No, its embedded supply chain issues will go away. No, they won't. Wage inflation will reverse. No, it won't. And so on. All this complexity has confused the herd mightily. Keep it simple, stupid. No longer works. Then there's the foreign exchange. The relative value of currencies barely move. Who cared what micro moves? The yen and yuan made other than currency traders. But now FX moves are big and spooky. The herd became complacent. Everyone forgot that currencies matter. And now the herd is skittish. What the heck does the yen and yuan getting crushed mean? Nobody's sure. And it spooks the herd. Globalization has also run off the tracks. It was also so easy for the couple of decades close to the plant here, shift production to sweatshops overseas, drop the quality of goods to boost profit margins, and Viola nothing to do with to watch corporate profits climb. Now the globalization is reversing. The herd doesn't know which way to run. Where will the easy guaranteed profits come from now? Energy has been cheap for so long, and energy is everything, guys. Energy is everything. Without energy, we cannot exist. We've been having it cheap for so long, the herd took it for granted. Now that it appears there are actual physical limits that might affect the financial castles in the sky, the herd is discombobulated. You mean the input cost of everything will go up? But what about the guaranteed higher corporate profits? After decades of being compliant pack animals, the workforce has started wandering off. Millions of workers are quitting every month, dissatisfied. I mean, everybody's a business owner now. That's just, I'm making jokes here, and I'm usually trying to read this with some satire and put light to a really situation. But it's insane the conversations that go on, insane how people continue to function with it and thinking that everything is going to remain the same. It's going to always be this easy, and we're going to have an unlimited amount of energy in a finite planet. But I digress. Let me go back to the article. The Wall Street herd believed the hype about robots doing all the work, and so automation would force workers to accept lower wages. But a funny thing happened on the way to lower wage nirvana. The workers' pay was no longer enough to pay rent, student loan payments, food, taxes, etc. The herd has no response to Marx being right after all, except in the deer headlights blank look. That labor might actually stop caving in to corporate capital is incomprehensible, and the herd is in a real spot of bother. The herd, fat, dumb, and happy after years of easy money, also has no means to comprehend diminishing returns. The fuel for higher profits and markets expanding debt. Nothing could be easier, and since the Fed will keep interest rates near zero, there's no real limit on debt, so borrow as much as you want. But borrowing more eventually ceases to generate the desired effect. Rather than boost revenues, taxes, profits, and markets, borrowing more now has a cost, and that cost is weighing on the gravy train. Then there's the global capital flows. For the past 13 years, money sloshed around the world, more or less making everyone who was already rich even richer. The herd liked this a lot, as the herd skims a percentage of all wealth and even a bigger chunk of new wealth. Governments like this too, because governments also skim a percentage of income, profits, and wealth that boosts capital gains and property taxes. But now global capital is flowing from the periphery to the core, and that complicates things. There are now bigger losers in the global casino that should the flow of global capital become a raging torrent. The winners could become losers faster than they thought possible. The herd on the street is whining. Please just make it simple and easy to make money. Sorry, herd on the street. Now you actually have to work to make money. From not producing any goods or services, the casino has become complex and no easy answers on predictable paths. I'm hearing good things about the yen Quatolo Battle Guano Slobian bond volatility ratio. You might give that a try. I tried, but I did a terrible job of reading that. Or just run with the herd and hope don't go off a cliff somewhere. And I love he gets it right from the Federal Reserve's data. And the Federal Reserve has all kinds of data information. And look how this chart is just one up. Notes added by Charles Smith of Two Minds. This is of April. That's here. Just look at this. All right. Another chart here, financialization, S-curve of rapid expansion. Fuel, expanding momentum slows. Decline phase will work well in the boost. Phase no longer works. Investors lose every bet. Leadership fails, momentum is down. Boost phase, virtuous cycle. Investors can do no wrong. Leaders are genius. He's showing now this S-curve of rapid expansion, stagnation, and decline. And that's the time we're living in. Charles Smith is a genius at this, in my personal opinion, and how he articulates these complex concepts in a comical way, and as well as just to put you to be aware of it. Take a look at his website, twominds.com. I don't get any pay from that. I just like the way he puts things, and I haven't read anything from him in a while. And these two articles definitely caught my attention. If this video has been any value to you, please subscribe, leave some comments. Until my next video, I'm out.